Welcome, everyone. My name is Angela Marsh. I am the Marketing and Events Manager for this Chesapeake chapter. Today, we're doing our Financials 101 Homeowner webinar. I'd like to thank Teresa, Don, and Odell for putting this on for us. And we are happy to send you the slides following the program if you would like. So I hope you enjoy. And I'll turn it over to Teresa, our moderator for today. And if everyone could please make sure they're on mute. Thank you.
Great. Thank you so much, Angela. And we thank everyone for being with us tonight. We promise to give you great information. And I am grateful to be a part of this training. And I'd like to introduce our presenters. Well, a little bit about myself. I'm CEO of American Community Management. I've been with American Community Management since 2009, when I actually entered the community association management industry. Needless to say, learned a lot about the do's and don'ts and all of the things that we want to do right in our industry. And education is really is so important in servicing communities. I also serve on the education committee of the Chesapeake Region chapter. Our first speaker, Mr. Odell Moon. He is the Vice President of Operations and Business Development for American Community Management. He is an experienced community management with probably over 20 years experience. He's been with ACM now for about 2 years, so I'm happy to call him a team member. And he's going to be talking to you tonight about a lot of the keys from a manager's perspective. And welcome, Odell, and thank you for taking the accepting responsibility for this presentation.
Thank you.
And then we have Don Plank, and he is, I call him a friend in the industry. I've known Don for many years, very insightful. He has managed community associations as well as both a site manager and portfolio manager prior to his current position as Vice President of Association Banking Services at NCB, or National Cooperative Bank. Don is very involved in multiple chapters to include Central Virginia, Chesapeake, DC Metro, and Southeastern, and has also taught numerous courses, including this one. So thank you so much, Don, for being a part of this presentation tonight.
Thank you, Teresa.
So I will turn it over to you guys. And just a little bit of a housekeeping tip. I will be monitoring the chat box, so feel free to ask questions there. They're going to pause in between slides so you can get your questions answered. And we thank all of you, most importantly, our attendees, for joining us tonight.
Awesome. Thank you for that introduction, Teresa. I'm excited to do this. And so I'm going to be taking the lead on the next couple slides. Odell will chime in. Teresa, please chime in. And please feel free, if there are things that we talk about on specific slides that you have questions about, feel free to put something in the chat, raise your hand, and we'll try to address that. And then if there are general questions that aren't something that we're necessarily addressing, there should be time at the end that you can ask those, and either Teresa, Odell, or myself will try to answer those. So just a little preliminary information. I'm not sure, I'm excited that there are as many homeowners as there are. I'm not sure if you're all treasurers, if you're board members, homeowners, whatever you are, I'm really glad that you're here. Part of this comes from my perspective. At the one place that I lived in a co-op in DC, and I volunteered for the board, was appointed to the board, and I served as treasurer for a couple of years. And I remember getting that packet on a monthly basis. It's a lot of information, and I realized how it can feel when board members get this big packet, and it's sometimes hard to know what you should pay attention to. And so tonight is, I would call it an introductory level course, where we highlight some key things that we believe that board members should pay attention to. Some of you who are on here may already know all of this. Fantastic. If you have something you want to add, that's great. But I hope that you can walk away tonight that the next time you get this financial packet from your management company, or if you're self-managed, that you are able to key in on a few things and not have to spend an hour or 2 hours combing through this, but you can quickly look at a few things and say, you know what, we're in pretty good shape, or I know the questions to ask management. Why is this happening? So as this slide says, often it can be overwhelming when you get this big packet. And I'd like to get away from, sometimes it's easier to just say, we'll just let management explain this. I think board members all have responsibilities, especially the treasurer, to look over management's shoulder at the financials on a monthly basis so that you know where you are. And I don't mean looking over management's shoulder in a bad way. I mean that the board member is just aware of it and knows what questions to ask.
Absolutely. Can't agree more.
I agree, Don.
Excellent. Let's do the next slide. Awesome. First thing that we're going to start off with is the three main accounting methods. And my guess is, in an audience of this size, we have people with different accounting methods. And I'm going to talk about accrual, cash, and modified accounting. Don't worry, don't tune me out. It's going to be very brief, and I'll go over them on the next slide where I just briefly outline them. So the first kind is accrual accounting. It's pretty rare to see a full set of accrual financials in the community association management industry. But the basics are income is recorded when earned, not when the cash is actually received. Expenses are recorded when incurred, not when actually paid. And you see this on often larger corporations keep their books on an accrual method. Any public company keeps their books on an accrual level, not so often for community associations. The next one is modified accrual. You see a lot of community associations on a modified accrual basis. Now, try to make it very simple. Income is recorded when earned, not when cash is actually received from owners. This can be very confusing, and I'm going to cover it again on the income statement. That just means that if, let's say, your association dues equal 120,000 a year, that would be 10,000 a month. That means the January financials will show 10,000 of income from association fees, regardless what owners paid. Owners may be paid a total of 8,000, but on the income statement, it will show 10,000. That's accrual accounting on the income side. On the expense side, that's not typically done. The expenses are typically recorded when they are actually paid, when a check is sent and a paid is billed. Many associations are under this model. The last one, the easiest way to explain it is how you and I do our checkbooks. It's when we get money when I get paid my paycheck, I record it, shows up in my bank balance. When I pay my credit card bill, my electric bill, it's when the money goes out the door. It's a simpler way to look at financials, but it misses some key things, which is why many associations do this modified accrual. Odell and Teresa, do you have anything to add on this, distinguishing these that makes it, that helps clarify?
Adele, you want to add? You mute.
No, I think you hit on all three keys. And as you stated earlier, all three keys are different, but the modified accrual is in most cases the one that's normally used. However, there are communities that use accrual. So you need to, I would strongly encourage you to identify what method is being used at your association that you're utilizing, and have and kind of fill in the blanks of any questions that you may have. So Don, great job.
I was going to say the exact same thing. Make sure as board members, you're aware what method your management company is using, because it can be misleading if you're expecting, for example, if your expenses are on a cash basis, but you have $20,000 in outstanding bills, that's not going to show up on your budget report. So it's very important to ask what method is being used,
Yes.
and to have them report any open items as well.
Excellent.
We have a question. So the question is, if we're tracking overdue accounts, I'm assuming this means collections, would that be modified accrual or cash, or could it be either? Would you guys like me to take that, or you want to take it, Don?
It could be either one.
It could be either one.
Yeah,
Because it's a separate report, and you can't necessarily tell just from that report. But a little trick I use to tell whether I'm looking at least on the income side, accrual basis, is if your balance sheet, we're going to get to that, has an accounts receivable line item, you're looking at accrual or modified accrual. It's a little trick to use. Teresa, do you have anything you want to add on the overdue accounts?
Yeah, absolutely. Yes. Your financials can be tracked on a cash or modified, but you also should always have a collections or AR aging report. I don't think that should ever be absent. So I agree with Don. The financial reporting method could be cash or accrual. And yes, looking at the balance sheet is where you would see that, the receivables, the payables on the expense side, et cetera.
Right.
If you're on accrual, if you're on cash, you're not going to see any of those accounts on your balance sheet.
Cindy, I see your question, and you're multiple steps ahead of me as usual. So I'm going to answer that question in a couple of slides.
Okay, great. Thank you guys for the great questions.
Okay, next slide. Awesome. Okay, the three main things, there are multiple things included in your monthly financial statement. The three main ones that we're going to focus on are the balance sheet, the income statement, and just remember, the income statement, it can be confusing because it's called different names. Yes. Your management company accounting software may label it a P&L, which stands for profit and loss, or it may spell it out and it may say a profit and loss statement. They're all the same thing. They just call it slightly different names. And then the last thing is we're going to talk about the general ledger. And the general ledger is just like your checkbook register. A lot of us don't keep a checkbook register as much as we used to, but that's a good equivalent to use, and I'll explain a little bit when you might use it. Next slide. Okay, here's a typical balance sheet. So a balance sheet is divided into three sections. You'll see that top section is called assets. And you see the total assets line item of $549,000 and change. It's made up of multiple items, with the main items being cash in the bank. I'm going to cover it a little bit more later. The next section of the balance sheet is liabilities. That's what the association owes people, contractors. And the final section is the equity section. And so think of it this way. This is basically a snapshot of the net worth of the association. So when you and I look and we try to figure out how much we're worth, all we're doing is we look at our bank accounts, we say we have this much cash, we owe, our house is worth this much, so that's on the asset side, that's how much we have. Then we subtract anything that we owe. So we subtract our mortgage balance, we subtract credit card balances, anything that we owe, and what's left over is our net worth. So when we go out and buy want to do financing, this is often they build in basically a balance sheet on the application. And so we do this personally. This is on the association's behalf. What we have, what we need to subtract because what we owe, and what's left over. Those are the three main sections. And I'm going to go over the sections just a little bit on what is important to key in on when you look at this.
And if I could just add on, one thing that we should see in an association balance sheet is, as you have here, the operating fund separated from the reserve fund. That is extremely important because it's based on fund accounting, and there shouldn't be any commingling between the two funds. And if there is borrowing between funds, which we'll talk about later as a red flag, there would be a due from entry to track. Okay, we owe funds back to the reserve, but there should also always be an equity section, a tracking, any asset section, a tracking of the reserves versus the operating. Okay.
Okay. If you don't remember anything else tonight, remember you have to look and see how much cash you have. Cash is king. You can't pay bills without cash, and you get very upset vendors. So if nothing else, always look and see, what do I have in cash? And if you look at this is on the asset side, you have the operating account. Operating is just a different name for a checking account. That's where all your monthly bills are paid from. The reserve account, you see there is a second line item. That is the account where you're saving money to pay for longer term projects that don't happen each year, things that are outlined in your reserve study. Then they have, and this is very normal, it's very common that not all the funds that are in reserve show up in just one line item. So this association, they have a regular reserve account, very likely it's a money market account, which just means it's easily accessible. But like many of your associations, you want to invest your funds to get at least a little bit of interest, often a little bit better than what a money market does. So what this association did, they bought a SunTrust CD at 1.75%. I wish that was available today. This is back when they bought it back in 2020. And that CD, they have the balance there, is worth a little over $200,000. So those three items together tell you how much cash the association has. You always want to know that, because you need to have money to pay the bills, and you need to be saving money to pay for those roof repairs, street repairs, longer term items. The next one, and this is, can anybody tell me, is this balance sheet on a cash basis or on a modified accrual or accrual basis? Anybody want to take a guess? Yeah. What do you think?
Modified.
Awesome. Cindy, you are the winner. Why, Cindy, do you want to speak up? Do you want to say why you think it's modified accrual?
Because it looks just like our statement. And our statement is modified accrual, and it's a little perplexing because there's, well, in the asset section, of course, it's, you don't actually have the confusion that I have with modified accrual. I'm still learning. That's why I'm here in this wonderful one class.
Awesome. So,
But, things like when the interest of your reserves is exited out, and so no, I can't answer your question.
I would like to answer that
Like
question. Cindy, I would like to answer that question about the subtracting of interest. And I can't speak for how your management company handles it, but what I will say is interest should be allocated to the fund on which it was earned. So if you're looking at your operating budget report and you're saying subtraction of interest, I'm assuming they're backing it out to allocate it to reserves, because it shouldn't show up in your operating statement. It should be allocated as reserve interest. So that may be just their accounting system way to allocate the
Exactly.
interest to the right fund.
Thank you.
Okay. So the answer I was looking for is you have accounts receivable, or they call it assessments receivable on this balance sheet. When you have that, you know it's some kind of accrual accounting. Because if you don't have, if it's cash basis,
didn't know
that
that.
will not show up.
Huh.
Okay?
Mhm.
Little tip. The next thing is that you want to track those. I would say, you can't do everything because management does a good job pointing things out. So I'm skipping over some things because if I tell you everything, you get you don't do anything. That's if I feel overwhelmed, I just don't do anything. Right. So I'm just going to point out a few things. So look at cash, look at accounts receivable. The next thing you should look at on the balance sheet is under liabilities. You see that next circle, it says AP, stands for accounts payable. Are there any it's very normal to have some accounts payable, but are there any large items that are sitting in accounts payable? If there are, you should ask the question, why is that sitting there? Is there not enough money to pay the contractor? Is it an invoice that is being disputed? What is the reason that it's sitting there? So if there would be a $10,000 line item there, depending on the size of, this is a smaller association, I would have questions. I would say, what is this $10,000 item that we owe under accounts payable? And for the purposes of this class, I'm going to skip this bottom section, the equity section. It would be fun to do an advanced class where Teresa can go into all the CPA details.
So you're doing just great, Don.
Of the equity section, but I will say this, the equity section can be very confusing. Always remember, it doesn't matter what this number says down at the bottom, that is not how much cash you have.
Right.
Right?
That's right.
I get this. Managers even get confused on this. You only have as much cash as you have in the bank.
That's right.
So if you're starting out, just skip that bottom section. Let your auditor explain it. Maybe we can do another class where we get into that. But I don't want to get too much detail in that tonight.
Don, we have a great question about prepaid owner assessments.
Oh,
yeah.
Awesome.
Why are they considered a liability?
That's great. So think about it. So this, let's say you live in your community. So this balance sheet, we did this class a year ago for somebody else. And so the balance sheet is as of April 30th, 2021. There are prepaid owner assessments of $26,702.01. They show up as a liability because many owners paid assessments that are past April 30th, 2021. For example, very likely it's for May 2021 or June 2021. They paid ahead. And so think about it. If the association were to go out of business on April 30th, 2021, those people paid what they wouldn't owe. And so the association would need to give that money back.
Oh.
So it's tracked by listing it as a prepaid owner assessment. Teresa, do you have did I explain it well enough? Do you have something to add?
You did great, Don. You don't need me here.
Okay. And
no, I mean, that's exactly right. It's paid, the payments in advance are technically not due yet. So we can't count it as income yet because they're,
Yep.
So since they can't count it as income, they have to be tracked as liabilities.
Yep.
Correct.
And Sean, it could be either one, modified accrual or true accrual. You can't tell just from that line.
Correct. Because sometimes you'll see modified the other way around. So sometimes you'll see the expenses are cash and income is accrual, or you'll see the income is cash and expenses are accrual. So you really have to ask your management company what their method is.
Okay, let's move on. Okay, just a general overview. This is an important statement. This is in this software program, it's called an income and expense statement. It could be called a profit and loss statement. There are different names, same thing, but it looks like this. And when you just look at it, you're like, there are way too many lines on here, and this is confusing. So I'm going to go to the next slide where we're going to break it down a little bit, because there's some great information on this income statement. So this blows it up a little bit. Look at the first circle. That just means it says current period. And if you look at the top, it says April 1, 2021 to April 30th, 2021. So those first three columns are for April, only April. Okay, so you can divide this income statement into sections. So the first three columns are for April. Then move over to the next three columns. It says year to date. I happen to know that the fiscal year for this community is on a calendar year. So the year to date means it covers the period from January 2021 to April 2021. And then on the far right-hand side, you have your annual budget, because it's really nice to reference the annual budget when you're looking at this. Almost all accounting software programs have this layout. They may call it something different, but it's very common to have this layout on an income statement. So when you see that before, when we looked at that screen and it just looked like a bunch of columns, look at how it's divided up, because it goes by sections. And so Cindy, on the next slide, I'm going to actually, Teresa, can you go back one slide? And I want to answer Cindy's question earlier where she said, how can you tell how you compare actual to budgeted? And so what we would do here, let's look at those first three columns again. That first column is, so remember, the first three columns are April only. You don't do anything for the previous months. So at the top, that first column says actual. That's what you actually did. So let's go down to the bottom, and you see that you have net profit or loss of $4,835. That was the net profit for April. The next column is the budget. All it does is it takes the annual budget divided by 12, and you get the individual line items there. And at the bottom, in a perfect world, you should have net income of $2,717 based on your budget. Your actual is $4,835. So you're in a better position than what you had budgeted. And then that third column, actually, I'm getting ahead of myself. I'm going to go to another slide to talk about what the variance is. Teresa, you look like you were going to say something.
Yes, I wanted to just address Cindy's most recent question. If modified accrual uses the budgeted as the actual, what is the purpose since the real dollar is not identified? So the budget is the budget. So the cash versus modified accrual versus accrual, when you look at that actual column, that's the one you have to be concerned about. So for example, if this is cash basis, which you know this isn't, that $15,538.75 would be actual cash coming in the bank. If it was accrual or modified accrual on the income side, that would be the budgeted or the billed assessments through April. So I'll be honest, to me, this looks like it could be Because if I take that budget and divide it by, over 4 months, that doesn't look like accrual to me, but I'm not gonna go that deep. But yes, so that's where you would tell if it's accrual or cash is based on this actual column. The budget column should just represent the budget that was adopted by the association. I hope that answers your question.
No, it doesn't. They're the same.
Yeah, so when you use accrual on the income
It would be
side,
the same.
the actual and the budget are the same. Okay, so that's another hint. If the actual and the budgeted on the income side that's another tip that you're dealing with accrual.
Right.
Because in the real world, it doesn't work out like that. And so so you can tell that that's why, and we'll get into it, since it's the same, you're like, but then how do I know whether people are paying on time? This makes no sense. How you tell is the delinquency report. That's why it's, okay? So the delinquency report will tell you whether people are behind. That's,
Yes.
and
So you
that's,
have to
as
look
Teresa
at
said
both.
earlier, that's why you always have to check that report. Because if in this association, let's say they have owners that owe $5,000 and they didn't, let's just pretend in this world, nobody had prepaid. That means they're short on the income side by $5,000, but it's not showing up on the income statement. It's showing up with cash in the bank and on the delinquency report. There are a couple places it shows up. So let's see.
We have a question about why would let's see, if we use the zero-based budget method, why would the budget show a net income? I can answer that, or I personally, I don't think the budget should ever show a net income. I think the purpose of a budget is to project your income and then match that with your projected expenses.
Yeah.
And when we talk about zero-based budgeting, it's don't start with income, start with expenses and then build from there. We don't want to force it to fit, right? We want to be as realistic as possible as it relates to what is it going to cost us to maintain the community. So a lot of times we'll see, there's this attempt to, where our assessments are this, we want to fit all the expenses. That's not zero-based budgeting. Zero-based budgeting simply means wipe out what you spent last year and look at each line item and come up with a realistic number. But at the end, it really should balance because you typically should generate enough assessments to pay all of your bills.
So look in the far right column. It says yearly budget. Now look at the bottom, 96 cents. It's a zero-based budget. So very valid question. Why does the current period budgeted show an income when on the far right, the annual budget doesn't show a net income? And I didn't do this budget, but very likely what they did is they went a step further. Rather than dividing all the management, all the expenses by 12 for 12 months, if they're really into doing detailed budgets, they're going to take their snow removal budget and they're only going to budget it in the winter months, not summer months, right? So it's not going to be exactly divided by 12. So because let's say we're down in July, if you still have a snow expense showing up in your budget, you're not going to do snow removal in July. But often the easiest way, the system just divides it by 12 and pretends every expense is equal in every month, but it doesn't happen that way. And so my guess is the manager in this association went in and tweaked when the actual expense due to come or paid. And in that case, on a monthly basis, you may show an income, budgeted income, or a budgeted loss. And that's why, because you can allocate the expenses to 2 different months of when you think they might occur. Same thing with irrigation expenses. You're not going to be paying irrigation expenses in December unless you're late paying your bills. Okay, I got a little off track. Can we go to the next slide? Okay, and let's go on to the next one.
I think she has a question.
Oh, okay, sure.
Sit. Have a seat.
Sorry. I answered Diane directly just so we can move on, but the question was, why is the income the same as budget, but the expenses are not? This is modified accrual. So what that means is they're reporting the income on accrual. So it's the same as budget, but they're
Right.
reporting the expenses on a cash basis. So they're reporting it as the actual expenses that they're paying. Does that make sense? So that's what makes this statement modified accrual, because it's not the same. I agree. I think there was
So Teresa, probably I asked this question too, and my guess is other people are asking that. Why bother doing modified accrual?
Well, personally, I have a preference for cash or accrual. I think that it's confusing to have a kind of a mixed bag of an accounting method. And what I see a lot of times is it confuses boards to even do accrual. So we always ask our client, well, what is your preference? A lot of people don't understand accrual accounting. I mean, it's just an advanced method, unless there's like a corporate background of some sort. So yeah, I have to say my preference is for one or the other, not a mixed approach. Because when you get an audit done, they're always going to convert it to full accrual, regardless of what method you start with. An auditor is going to convert it to full accrual. That no auditor would use modified.
Let's see.
Thank you, Teresa.
Sorry.
Okay, next slide.
Okay.
So when I was treasurer of the co-op, I loved the variance on the income statement. It is a really quick way to find areas to key in on. And so, for example, in this, mostly I would look on the expense side, because I'd be trying to find expenses that are out of whack. Do we have any issues? Is the water bill over again? Whatever. So a variance, all it means is the difference between actual and budgeted. And it's done on both a current monthly basis, that current period section, and it's done on a year-to-date basis. So if I get my income statement, I can just circle the variances and I can quickly scan down and I can see, are there any issues that I'm concerned about? So let's look here. I go down, 1616, that seems like a big number, but then I look over there and the actual was $50, the budgeted was $1,667, and I'm like, that's in my favor. That means I spent less money than was planned. I'm okay with that. If it keeps on going, I might say, well, that's our grounds improvement budget. We wanted some grounds improvement. Why are we not spending money? Are we behind? Like, so let's say it rolls around and we're in September and we still haven't spent any money. I'd be asking, what happened? Like, I thought we were going to plant geraniums this year. Like, are we behind or what's the deal? Then I go on down, a negative number on the expense variance is a bad sign. It means that it's bad, and I use bad relative. It just means that I spent more than what the budget said I should be spending. So let's look at that. Irrigation system maintenance. I spent $1,671. The budgeted amount was $1,400. Okay, on the grand scheme of things, that's not a huge amount, but let's say that keeps up month after month. By the end of the year, I'm close to $2,800 over budget. That's significant. So this gives me an alert. Okay, I want to watch that next month. Are we going to be over budget again? I can go over on a year-to-date basis. I can do the exact same thing. Are there any negative numbers on the expense side? If there are, let me figure out what's happening. Did we maybe pay two bills? Maybe we were late paying the 1 month and they got lumped together. So I love variances. They make looking at an income statement easy. The other thing I want to point out is look at that little star on the left. You see that little star? It's by a number that says 51,000. If you're if you're looking through reports, it can be hard to look at names and find names, okay? So grounds contract, ground improvements, you're scanning along. But let's say, especially as a treasurer, as you want to make sure things are coded correctly, 51,000 means grounds contract. That 51,000 is going to show up in other reports. And I think it's much easier to find a number than it is a name because they go in order. And so you can quickly scan through if you're talking with your manager and say, I'm concerned about this. And if the manager's saying, okay, look on page 3 of the report, look at 51,000, you can quickly find it rather than scanning this whole thing. I love account numbers. It makes it easy to find stuff. Okay, let's go to the next page.
Don,
Yeah.
can I chime in real quick? One of the things that I like to really quickly, that's on this variance report that that our homeowners need to know and board members should know, that there's 2 areas that I normally look at from a managerial perspective when I see things that are out of line. I want to make sure that the actual line item is in the correct GL. That's number 1. And normally in the utility section, at the end of the year, you always have, when it's changing over, you always have that overlap of the utility bill that came from the previous year, because as you know, they go month to month. So, but most of those cases, if it's in a line item where it's a contract, just definitely want to revisit the contract, see if the contract price increased. And as Don said earlier, especially when you're looking at your seasonal items, you want to make sure that that your manager is putting those particular items in the exact months and not amortizing them across the board for 12 months. As Don said earlier, those do sway your budget. And the last thing I want to say is always put those items, even if they're out of line, put them in the correct GL, because that correct GL gives you a snapshot at the end of the year, and it helps you for your future budgeting processes to look at that area and say, hey, this is what it cost us last year, and let's look at the years and what was that anomaly? Was it anomaly, or was it something that's going to be consistent, and we need to budget accordingly? That's all.
Right.
Great point, Odell.
Absolutely.
Because let me give an example, and I've had boards tell me this. Look at the grounds contract. The annual budget is 55,000. The ground improvements budget is 20,000. So I've had boards say where they're under budget on the ground improvements,
Right.
and they have an expense that's really the grounds contract, but they don't like to look like they're over budget. And
Right.
they say, code it to ground improvements. Bad idea, a very bad idea. You're only fooling yourself, because what Odell said is true. You need to just be realistic. That means when you get to budget season and you're looking at what you spent for the year, you can't depend on these numbers. And then that means you don't budget correct for the next year. So budget based on the expense, put it in the correct line item. It will help you.
And we'll thank you, Cindy, for your question. We'll try not to use
Yes.
acronyms. GL is general ledger. And the opposite is also true, Don. We always ask our managers to be sure and look at their grounds bills to make sure they're breaking out any improvements versus the contract, because some landscaping companies will merge them together. So yes.
And lastly, I want to add, yeah, your budget looks larger, but the more that I'm on the adage as a manager, from a managerial perspective, the more line items that you can have that they can definitively show where the money's going, it's consistent. In case someone like a Don Plank comes from the bank and looks at your codes, he doesn't have to dig down into those line items and say, hey, why is this out of whack, or what have you. So it's important that we be as truthful and honest. And if we have to develop another general ledger code, we'll do that to show that particular item where that money's going.
Excellent. Did I miss a question? Diane Phillips says, but it's not the same. Isn't the water bill different?
I answered that.
Okay, awesome.
Yeah.
Thank you, Teresa.
Was that sufficient, Diane? I hope so.
This is a great one. Miscellaneous.
I know, yeah.
I had a boss when I was managing miscellaneous items were a no-no. It's so easy to bury items in miscellaneous.
Yes.
Mhm.
So you need to, there may be a legitimate reason for it, for some really small items, especially if you're a large community, but it's really easy to bury items in miscellaneous that should not be buried in miscellaneous. So I'd be careful with it.
I agree, Don. I try to never use, and even me and Don come from a historical place together, never use miscellaneous income. Never. We never use miscellaneous income. There's a place for that particular dollar to be placed. And when your accountant and your auditor comes through, they have to dig through that miscellaneous income line item, which is the GL code, to find out what's in there. And most of the time, they reclassify a lot of those items. Either they're going to be in your reserves or they're going to be in your operating, and people put them in miscellaneous income, as we said earlier, so they want their numbers to look good. You're only fooling yourself, as Don says.
Yeah, the exception I would say, you may have, like, especially if you have a site office, maybe you have $500 budget for some, like maybe there's but probably a better title would be, you know, whether
Office
it's
expense.
office expense. Something that you can tie
There's always
to it.
something to call it that.
Miscellaneous, just, you have no idea what it is. It's, as a manager, it's a great line item to bury things in.
It's like a slush fund. We don't like slush funds. We don't.
Nope, no slush fund.
No. Stay away from other, and I know a lot of people budget for contingencies. I just don't think it's a good idea. And it's more you have to explain to your homeowners too. If they're looking at a budget and there's $10,000 in this miscellaneous, like, well, what is that? So transparency is key.
Absolutely. Totally agree. And when I said it's easy for a manager to use that, I wasn't saying anything negative. But my last place I was a site manager. You want to have a good budget. So you're like, okay, I'm already over budget. It can maybe kind of be put in miscellaneous, doesn't look as bad, just not a good idea. So now we're back to general ledger, or GL, or another name for it is trial balance. Remember, all this is, and there are pages and pages of this report. It's a checkbook register. That's all it is. So you can go, remember, this is where those numbers come in really handy. Remember, I talked about the number 51,000 as a grounds contract. You're like, who's that? What was that bill for the grounds contract? You can go to the general ledger or trial balance or GL, whatever your company calls it, your financials, and you can go find the number 51,000. You're like, that was a bill paid to Commonwealth Turf Enterprises for the April 2021 service. It's fantastic. I loved it as a treasurer because often line items in a budget will have multiple expenses rolled up into one expense item. And so what you can do is you can go to the general ledger, you can look up and you can say, oh, total grounds contract was $6,000. And then you can see what made up that $6,000. So maybe part of it was for the contract, maybe they planted a tree. And so you're like, maybe that doesn't belong in that general ledger line item. Maybe it should be coded to a different line item to be more accurate. And so just use it. I use the general ledger as a place to go look up things that I can't understand how they got to that total in the income statement. Any questions about that? Excellent. And then the cash. I'm sorry, go ahead.
Did you want me to go back? Okay.
No, we're good. The cash disbursement report. This is, there we go. This is a report that will just list all the checks that were written for the month. So you can quickly go to this report. You can see all the bills that were paid. And so it's a great way to find in one place what all was paid. And next report. This on here, this system, accounting system, calls it aged owner balances. Another common name is delinquency report. Another name is arrears report. They're all the same thing. Couple key things that I would pay attention to. Most systems will give this report in 30, 60, 90-day formats. Very common. You should get it in that format. And the reason for that is the older your accounts receivable are or your delinquency are, the older, the harder they are to collect, and the more money you'll spend trying to collect them. And so when you have a report like this, if you have some people that are just 30 days over or 60 days over, try to get them caught up. Those are the easiest ones to get caught up. Once they're 90 days, 120 days, you're there with the collections attorney, you're spending money with the collections attorney, and it's just harder to collect that money. So try to focus on them as quickly as possible on the short end of that spectrum. So that's a really key report to pay attention to see how are owners paying, are they paying on time, are late notices being sent, are people being turned over to an attorney at the appropriate time. So pay attention to this. And the other thing I would say is this isn't Financials 101. This report should be done in executive session. This is not something that should be done in front of the whole community. So be careful about that. That this is not for membership to see. Like membership can see how much is owed, but you shouldn't be handing out details like this report. And isn't the cash disbursement report often the bank's check listing? Let's see, Cindy. Yeah. So that will often, what we didn't cover here is a reconciliation of the bank statement, Cindy. We didn't get into it in this presentation, but you will often see the same thing. And so let's move on. And I think Odell, you're going to talk a little bit about the sample reserve report.
Unmute. Just waiting for Odell to unmute. Okay.
Yeah. Wanted to do a quick overview and bring you guys up to speed on the reserve report. As you can see, on this particular budget, the reserve report is broken out with the revenue and the expenses. And in those two areas, basically, it's pretty simple. It's what you're putting into your reserves, what is based on your reserve study gives you that particular number, what you should be allocated to the reserves and broken down on a monthly basis over a 12-month period. As you can see, it says reserve interest income. That's the reserve interest income that comes in monthly. And then as you move down, you may have a reserve payment. Your reserve payment is the payment that you're paying into the reserves on a monthly basis. However, here's the expenses. And if you look down at the net income, this is what it comes out to be at the net income. However, in the reserves, this is all broken down in your reserve study. What drives your reserve allocation is your reserve study. So we'll get to the reserve study in another slide as we move down. Any questions? Next slide, Teresa.
All right.
What I'm going to touch on here is the budgetary responsibilities. Every community and every association does these a little different. However, This is the basic budgetary responsibilities when it comes down to developing your budgets. When you're looking at your budgets, in most cases, most boards and directors are responsible for establishing budget and adopting open meetings and monitoring the community's budget. That's just the overview of what the board is responsible for. The treasurer is usually responsible for the day-to-day responsibilities and preparation and review of the budget. He or she is typically the initial preparation in the initial preparation of the budget with the manager or an accountant that's identified with your management company. Next slide. The manager's responsibility. The manager's responsibility is very, very clear. We prepare the budget. We review the draft with the treasurer and the finance committee, if one exists. We revise the draft budget as needed by the board and as changes are made by the board. However, the initial budget in our case is developed with the actual numbers and looking at the actual numbers over the past year, historical data over the past 2 to 3 years in most cases, because we have to think about what has taken place in the last year or so, especially today with the pandemic. Things changed. They were a little bit different during that time. But in most cases, these are the processes that we go to. And also the manager's responsibility is to mail a summary of proposed budgets to owners prior to adoption. And that's normally a 30-day process that the homeowners have to review the budget. I think we have a.
Yeah, I was gonna mention that when you mentioned that the reserve budget should reflect the reserve study. We're not going to get too far into HB 107, but yes, across the state of Maryland, it will be required that you fund the annual contribution.
Yes.
Effective October 1, regardless of the county. There are 2 counties previously adopted that, Montgomery County and Prince George's, but yes, communities will be required to fund regardless of the percentage increase. So it's not capped by your bylaws, but I'm not an attorney. I don't want to go too far into it, but we had a recent training on that, and it was very clear that you should be funding your reserves at the annual contribution that's identified in your reserve study. If you haven't had a reserve study, they do grant you some time, I believe until next year, to comply. Okay.
Next
Back
slide.
to you, Odell.
Next slide. Why are audits important? Audits provide an independent review of the association's financial statements. And everyone is, I would assume that's on this particular Zoom, is aware of audits, and audits should be completed on a yearly basis along with your taxes. Ensures the association's financial position is accurately presented. That means they check all the checks and balances, as we stated earlier when I was speaking of the auditor. When he looks at your financials to ensure that your financials are accurate, and it basically looks at all money that come in and where it goes. It evaluates management's internal controls. It looks at your association, how they operate. I tend to, as a manager, if you're not getting an annual audit and your taxes completed, they both tying together, that's a red flag for me. That's just the personal, and Don and Teresa, you can chime in, but that should be taking place on a yearly basis. Shouldn't be pushed back. An audit, definitely, that lets you know where your money is actually being tracked. Test revenues and expenses against supporting documents. They also look at that when they're doing your audits. The auditor looks at the documents, what was spent, is this accurate, and does this meet the guidelines of what you should be doing with the association funds? If there needs to be changed or then there needs to be some tweaking done, it would be in the report once the audit is completed. I'll open that up to Don and Teresa if you want to chime in.
Yeah, and most, it's not just something you should do, but most government documents require an annual audit. But it is something that really is checking your management company. It should be an independent firm. So not someone that is a part of your management company. It should be someone, and you should have, as a board member, you should have the ability to choose the firm. Your management company can get the bids for you, but no company should coerce you to use a specific auditor, because again, that CPA should be independent of the management company. In fact, they're required to call it an audit. We have a few questions here. What level of audit is best on a yearly basis? So there's different types of what we call attestation. It's probably getting way too deep for 101, but I'll quickly answer that. You can have a review You can have a compilation, which is just what your management company is doing, essentially, just pulling your numbers together. That's not an audit. The next level from that is a review. Again, not an audit because the CPA is not expressing an opinion on your financial statements. So what we're talking about here is that highest level attestation agreement, which is an audit, where the CPA is saying, we agree that your financials are fairly or not fairly represented here. So an audit it's very important that it's an audit, not a review, not a compilation. And I'm happy to take this one if you want me to, Odell.
Sure.
So just briefly, the audit process there, usually it starts with, again, a CPA prepares the audit report. And we covered that it's recommended annually, likely required by your bylaws. The first step in that process is to enter into the contract. So essentially that's your engagement letter. It has to be signed off by the board. It should be always signed by the board, not the management company. That's basically giving them authorization to conduct the audit procedures. The next step is to actually conduct the procedures and testing. That usually entails the auditor requesting financial statements based on your fiscal year end from the management company. Typically, they're going to want a full trial balance, which is basically combining your balance sheet and your income statement, all of your general ledger accounts, and then any AR, as you talked about, any open assessments due, and also any bills that are outstanding. They also typically look at what they call a subsequent period. So if your year end is December 31st, they're typically also going to look at January to make sure there's not any bills that were paid in January that should be in last year's audit. Management is provided usually with questions and questions and requests for additional documentation. And then all of that is done, the letter, the financial statements are sent together as a package, usually with financial statement notes as well. And the final document is a representation letter that should be signed by the board and management, basically just saying, look, this is basically kind of a disclaimer for the auditor. We're auditing basically what we were given, and management and the board is saying we've disclosed what we know. You know, we haven't withheld any information. We're not aware of any fraud. We're not aware of anything that's not stated. So that's that. You guys probably feel like you're peppered with a lot of documents through the audit process, but the key ones are the engagement letter and the rep letter, we call it a rep letter that the board should be signing off on. And please, you know, encourage, if you have questions, your CPA should be available to answer questions for you. We have a question. Delinquencies have been bogged down due to COVID-related court closures and then overwhelming dockets. This has been, this is, I guess, a statement. This has been a difficulty. Absolutely. And that's why reviewing those AR reports are so important to keep track of collections. Don, Odell, want to add anything to that?
I think you stated it well. I think that the one comment I was going to make on the audit is the auditor will publish a letter and make comments about some things that a board should pay attention to. Or they might say, it looks like some invoices were paid twice, like you need to check on this. Or there's, it looks like you're owed a refund and we don't see a refund. Like there are some things that are often put in the letter that just, and then they'll give, that are worth paying attention to. Like they'll suggest you should be meeting with your insurance representative so that you can make sure you have correct coverage. Like they give some best practices recommendations. And so take some time, read through that in addition to the actual financial statements. So I'll tell you, when I look at an audit, when somebody wants a loan, at the end of they have the balance sheet, the income statement, and then they have lots of notes. I always read through the notes. There's a ton of information in there that gives you lots of details about the community.
Absolutely.
And I always use that, just one last statement, when the auditor sends back his information, his findings and his suggestions, I always utilize that as an action item so we can get that information back and ensure that action has been taken so you don't repeat that same action through another year. So that's normally in a 30 to 60 day, ensuring that those recommendations are adhered to, so you don't repeat those situations in another year. That's all.
Right. I think there's a lot of information in this slide pertaining to taxes, so I won't read all of it, but basically just know that there is an exemption available to homeowners associations. So I get this question a lot. Are we required to be 501c or whatever? No. The IRS provides it provides an election option for homeowners associations so that you're not taxed on membership income. However, there's a rule that 60% of your income must be from members. So if you have other sources of income, that could be taxed. An example of that is investment income could be taxed. And only to maintain this exemption, 90% of your expenses has to be for, as this says, the acquisition, construction, management, maintenance, and care of association property. So when your CPA is preparing your taxes, they're also looking at how the funds were used. There's a concept called unrelated business income tax. So if you're purchasing things that doesn't benefit the community, in some cases that could be subject to being not considered a functional expense. So it doesn't, it's not a deduction for you. I don't want to go again too far into that in 101, but I think it's important that it's known that basically most of the time an association isn't paying a substantial amount of taxes. If you see a small tax bill, usually it's attributed to investment interest that has to be taxed. And then there's a couple of options, tax forms that CPAs can use, the 1120H or the 1120, and it's really going to depend upon what's more advantageous for the community. Right. So this is really just an overview slide. Just going back to the financial statements, what each of them represent. Don, Odell, you want to chime in?
Odell, go ahead.
Well, this is like Teresa stated earlier. This is just an overview of all the information that we've just covered and the measurements, how they're used to measure your processes in your financials. So it's a timely and accurate data drive for good decision making. So if you want to, when you get your slides and you get your copies of your slides, you can always revert back to this particular information and see exactly what that information entails.
And I'll just say, if your financials that you're getting does not clearly present all of this data that we've gone over today, please request the information. It's important to have the full picture of how your association is doing.
Yeah, and along with that, so every different software programs have a little different look to them. And so if you're confused about how the financials look, ask your manager to just go over the key items with a set of your financials. Set aside 15 minutes in your board meeting to just go over a few key items, or have a meeting where you do that's what is done, where management says, okay, here's your financials, let's just go through them and we'll point out a few key things. I find it's really helpful when you have a set of financials in front of you and you can just go through them and somebody says, okay, look on page 3, see that line item right there? That's what this means. And so if it's a little confusing, management is most management, they're more than happy to go over this and teach board members on what should be paid attention to.
Absolutely. And this is another kind of overview we know we've covered a lot tonight, so we wanted to kind of give you another reference for just looking at, often there are red flags. We all know about Surfside and some of the other, you know, even local communities who've been mismanaged financially. And it's important to get ahead of these things. And, you know, sound financial principles like using your reserve study, following the guidelines of your manager and your auditor. It's extremely important, not trying to hold assessments. I know that's a topic, but holding assessments $5 at the detriment of not funding your reserves is not a smart decision over time, because again, we're trying to accumulate funds over time. Steady decline in cash on hand. You know, there are a lot of things you can look for. The operating account should have at least 3 months of, you know, operating budget in it. You know, there's always unforeseen things possibly, or emergencies. So you don't want to be cash poor, but you don't also want to have a boatload of money unaccounted for as well. So yeah, I just wanted to point out a few of those things. Guys, feel free to chime in.
Yeah, when compiling, when we were starting this process, we really was tasked for some of the warning signs. Obviously, this is a volunteer position for you all. And so when we're developing this, came up with this sort of number of items that are definitely warning signs that will just jump out to you and ask those, for you to ask those particular questions that Don touched on earlier and Teresa touched on earlier. This is all to help you all understand and navigate your way through the financials and not just assume that they're all good and everything is working well until the end of the year. It gives you that warning light, that siren that says, hey, let's take a look at this, especially when you see general ledger GLs or accounts that are out of line and things like that. However, I strongly encourage the treasurers to have a dialogue with your management company, with your board, with your manager. If there's an assigned accountant to you, try to have that at least once a quarter to help you navigate through those processes and get a better understanding. And that way you can better explain that to your homeowners in your meetings. However, it's vital. So I appreciate you guys taking your time tonight. And I look forward to any time we can speak with you all and kind of help navigate and answer your questions. It's extremely important for us to do that in this industry.
Yeah, and we definitely still have some time to take some questions. Yes, Cindy, thank you. Yes, I just saw that too, the GAP, generally accepted accounting principles. And that's just saying your financial statement should be using one of those methods that Don talked at length about: cash, modified accrual, or accrual. Those are the accepted methods. They're always ask, as Adele said, always ask if there's any questions. Your man should be explaining. Again, it's also a responsibility of the board to understand what's in those financial reports as well. Ask for any documents that are missing, bank statements, invoices. You should be able to tie back to your financial reports. So let's just see if there's any more here. Yeah, so we're at our Q&A portion. So feel free to chime in. Okay, Donna missed the definition of cash accrual and modified accrual. Do we want to quickly, because we spent a lot of time on that, do we want to quickly summarize, or we are going to provide the slides, and there's a great slide in this presentation, Donna, that goes over that. Thank you, Cindy. We've got some great compliments. We appreciate that. Anything else we can clarify for you all?
Remember, know how much cash you have, just like personally.
Yes.
You gotta have cash. Otherwise, my bills aren't getting paid. And know how many people are delinquent. And then if you're over budget consistently, find out why you're over budget. I think if you pay attention to those things, you're off to a great start. You don't have to understand everything. Kathleen asked Teresa the difference between the cash disbursement report and the general ledger. Do you want to take that?
Sure. So yes, the cash disbursement report should be basically a summary view of everything that was dispersed for that time frame. So the GL remember, is comprised of all of the accounts that are in your financials. So if you look at that GL account, that's your operating account, you should be able to pretty closely mirror that to that cash disbursement report, at least the disbursement side, all of the, the outgoing funds. But the general ledger is also going to include your receipts. So it's basically just an extraction from your general ledger to show you in a quick view what items were paid that month.
Cindy, did you see Cindy's question, Teresa?
Okay, let's go back here. Got a few to come in. Let's see. Yep, Gap, I answered that one. Which one?
So Cindy asked, if delinquencies are stuck in course, are there options for balancing the budget? Yes. So one thing you can put in your budget is a line item for bad debt. That's an estimate of what you think you might not collect. And so
if you're on accrual.
if you're on accrual,
so that's something
not for cash.
Yeah, exactly. Now for cash, we recommend that when you budget that you make an adjustment for your, because it is a budget, but there's no entry for bad debt on a cash basis. But what you can do is that rather than budgeting for 100%, when you know you're not going to collect 100%, put in an amount that adjusts for that. So you're not over budgeting expenses, because you'll just build yourself a shortfall. So let's say, for example, your assessments, total assessments you're supposed to collect is 500,000, but you got a 10% delinquency. That 50K should be an adjustment to that budget. It would be very misleading to budget for 500,000 worth of expenses when you're only going to collect 450. So I highly recommend, that's something we've introduced, and because it helps to prevent that overspending and match it with your actual cash receipts. And usually you can look at the last 2 to 3 years of collections and see about what percentage of your owners are paying. And obviously, if you have a great attorney, it's going to offset some of that as well. You should be getting, some of that recouped, but that's extremely important, even on a cash basis. Okay, so we've got some more questions here. Let's see. All right, so the HOA has not yet been turned over to the homeowners. Our budget that we've received for the last year doesn't represent what you have shown us. What will our task be when the homeowners take over in the area of the financials? So what I can say to that is, yes, usually when it's with the developer, it's a pretty slick, streamlined budget. So the challenge to the new board is going to be, once all of those, the things are in place, the real expenses start to kick in, right? It is so important to sit down and prepare a realistic budget. Yes, I mean, that's pretty much what I can say. I mean, because during the development period, they may be offsetting some. A lot of developers collect working capital. It's probably not going to be the same budget that you're going to need going forward. So I hope that answered your question, Joyce. Okay, I'll take the next one from Barbara. If a third into your budget, a line item has an unexpected cost, but it is less than the requirement to have an adjusted budget vote, how do you pay it? Thank you. I'm not sure I understand that question. Barbara, do you mind clarifying that? Thank you. So are you referring to like an additional expense after the budget has been adopted, or during the adoption process? After adoption. So I know, I mean, it depends on whether it's condominium or HOA, but I know that the guidelines do allow for adjustments that are for safety and emergencies. But anything over 15%, my understanding, and Adele, Dawn, feel free to chime in, is that it would require a vote to amend the budget. You're muted.
Yes, it would. Yes, it would.
Mm-hmm.
It would. But I'm trying to understand the question. I'm rereading the question.
So I think she's saying there's an expense after budget adoption, and it's less than the requirement to have a budget. Yeah, I mean, if it's a 5% cost, and think about it, you're also looking at the overall expenses. So you may have savings in some line items. So just because you have an expense come in of 5% expense, that's not budgeted, doesn't always mean you have to amend your
Right,
budget.
you wouldn't amend the budget.
So look at where you may have had savings and can reallocate funds. We would always look there before.
But I would go back to
having
something
do
else.
it
As you said earlier, Teresa, not to cut you off, what I said
Oh, no.
earlier, I would also look at, if there's an unexpected cost that came in, look at it may be something that comes in, if it's a reserve cost, then it's going to come out of the reserve items, and that could happen at any time. You don't know what could happen on your property. However, if it's something and it's operational, it's just, for me, I would, depending on how large it is, I still wouldn't go back. I would just put that in the line item, and it would be an anomaly situation that happened, and it would be explained in the management report and in the financial. So when you go back next year, you know why that instead of $5,000, it was $15,000 because you had a situation, a maintenance situation that you had to address, a pipe underneath a unit burst or something like that, and it's a maintenance issue and not a reserve issue. So it could vary. It depends on what's the nature of its
Depends on the nature
operational
of the
reserve.
problem. Yeah.
I think
And the nature of the issue. Yeah.
yeah. I think the other thing that brings up is that a lot of communities will do like an operating reserve line item where so a regular budget will have a line item in it that nothing is coded to, but it's like it helps build up some extra money in your checking account for these unexpected expenses. So think about snowstorms. Some years we hardly have any snow removal. Other years we have huge snow removal expenses. And so you need to plan for that. And one way to plan for that is putting in an operating expense line item or operating reserve in your budget is like a fake expense. And so it forces you to save some extra money for some of those larger items that come along. Like maybe every 3 years we have a big snowstorm, you have a huge snow removal expense, and then you have some extra cash saved up so you can pay it, and you aren't suddenly scrambling to try to figure out where you're going to get the money to pay this huge bill and not rob reserves for it.
Yes, we definitely don't want to do that.
Excuse me, one question. So related to what you just said, I had asked earlier about the difference between miscellaneous and a contingency, and it sounds like what you just described would be that contingency fund.
Yeah, it's like it's contingency fund.
But it's not a miscellaneous line item.
Yeah,
So when
nothing is
that
coded
expense
to.
happens, it's coded to an actual budget line item. But the fund that Don is talking about is extra cash, so you're not depleting your operating account.
Yeah.
I also wondered, are there issues with when you're using an attorney to go after people that have been delinquent, and then the attorney's fees are racking up, and you start to wonder, well, like, is this really helpful because you're paying the attorney a certain amount, and the amount you're collecting from the delinquency is not comparable. I don't know if I can present that any better, but I just wondered if how would you address that in a budget? Like, because the attorney's going after folks, but then his charges for his fees are also being accumulated, so.
Yeah, so if you're spending attorney fees, that will show up as legal fees in your budget. But then the other thing is, if they do collect, like often they get those legal fees back and they'll show up again up on the income side of your budget. And so eventually, in a perfect world, those things will even out. You're right, they never, at some level, you'll have to have a discussion with your attorney. Is it worthwhile spending a lot of money with your attorney to go over some really small balances? Where we often see that is, especially on homeowner associations that have really low fees. and maybe they only get paid annually, and it's like street maintenance, and some people just aren't paying. So what I've seen is they'll work with their attorney to put a lien against the unit, so that if they sell, it's on record, and they don't spend a ton of legal fees going after them, but they put something there so that it's in place. If you have a more significant fee, then like the assessments are the lifeblood of any association, and you have to make sure that you're collecting them or doing the most that you can to collect them.
Thank you.
I don't see any more questions right now, but we would like to just thank everyone for your attendance tonight. And hopefully we will be able to bring you some more programming on this, maybe a 102. But we thank everyone for all of your great questions. This has been great.
Thank you all. I appreciate it. Appreciate you guys taking the time to meet with us tonight.
Absolutely.
Great job, Teresa and Don. Great job.
Great job to you guys. And
Thank
thank you,
you.
Angela.
Same to you.
Thank you,
all.
Angela. Thank you, Angela.
Everyone, have a great night.
All
Good
right.
night.
Good night.
Good night.
Good night. Thank you.
Good night.